Markets, I think, are hoping for a Goldilocks number, one that's not too hot and would bring the Fed back into play at least earlier for 2019, and one that's not too cold, which would bring back those recessionary concerns that are out there in the market. Here's the expectations: 198. This is the context in which parts of the market are expecting a recession or some kind of slowdown next year. We're going to print a 200,000 jobs number. I say that with a certain amount of sarcasm after doing 250 in the prior month, and a 3.7. Oh my God, how high is that? I don't know how low. Unemployment rate will be unchanged. Average hourly wages look to be up 0.3%. And there's the ADP, a little bit light, but not enough for anybody to really change their forecast. Here are the special factors we're watching today. Holiday hiring. The numbers expect a lot of holiday hiring. They lop it off, and then they wait to see if that lopped off number is higher or lower than the prior number. So
that's how they do it?
Yeah, there's a seasonally adjusted. You expect all the hiring, right? So is the actual hiring more or less than what was already expected?
But did they expect more this year? Because that certainly sounds like what the retailers were trying to do.
It's a rolling 5-year average is how they do it. I didn't look at the seasonal adjustment figure, but it has tended to be pretty strong. There were hurricanes, there were fires, and there were snowstorms to think about. Company-specific layoffs, including Verizon, GM, and Sears, they could play a factor. Tariff impacts, Goldman Sachs not expecting much in the way of that. The report, a critical component in Fed thinking for December and beyond. My reporting and comments from Fed officials find central bank thinking has shifted at least somewhat about the outlook for next year. Here are some of the things that I'm hearing. They're going to follow market signals and economic data. They are no longer, I think, hell-bent on getting to 3%, that perception or mid-range of the neutral range. The December meeting, look for a markdown in the 2019 growth forecast and look for a markdown in the 2019 rate forecast. And the outlook is just different. I mean, they see the market signals, they see the economic data, they see a little bit weaker, and so that 2.5% number for next year probably is going to come down. And take a look at the Fed funds probabilities. December back up to 81%. It was down in the low 70s. But now take a look. June, we can't get to the 50% agreement on the first hike for June. We got to go all the way to September. And I need to jog your memory a little bit, Becky, and tell you it was March back, I don't know, a month or two ago that
March isn't even.
We were like at a 60% probability of the first hike of 2019. So that's been pushed ahead by, what, 6 months.